to RawTake, everyone, the lifeline to your unfiltered media experience. I'm your host, Gion Thomas, and we got a great show for y'all today. We got a special guest. We got Mr. James Davidson. He's a retail stock investor. He's going to give us some insight on stocks. He's going to tell us about the Gamestop situation that happened last week. He's here to inform us. How you doing, man?
Doing well, doing well. Thank you for bringing me on, Gion. I'm excited to be here.
That's up. What's up, man? So yeah, like I was saying, man. So break down to the audience what exactly happened with the GameStop situation last week. Yeah, so just break that down.
Yeah, for sure. So I'm sure everyone's been aware. They've heard GameStop or they heard these terms short squeeze in the news. It's been going all over social media. I'm sure you heard the taglines, the hold the line, the diamond hands, all these terms getting floated around and out and about. So it's a little bit twofold. It's kind of it can get very technical and very difficult in the situation. But what happens is when they short sell, these big hedge funds in Wall Street, these big investment banks, they look for these companies who are quote unquote bad companies. Right now, a lot of retail stores that are closing, losing money quarter after quarter after quarter. So these big hedge funds, they go out, they hunt for these bad companies, and what they do is they short the stock. Now, what that means is the opposite of buying the stock, where you just go to your broker and you purchase the stock and you own the stock. The brokers, they hold all the stock and what they call it street name, and they keep all the stocks for the broker themselves. So the hedge fund will go to the broker and they borrow the shares from the broker. And when they borrow the shares, they resell them to the market. So the broker sells them out to the public, right? So then the market is flooded with more shares. And what happens is, for example, what happened with GameStop is it was very over leveraged. There were more shares that were being shorted than were available for the public. At one point, it was like 140% shares were being shorted, which is, logically impossible, but they found a way to do it. So broker A, I'll give you a little example so everyone can maybe get a little bit better sense on the situation. Broker A, sells the shares into the market once the hedge fund comes and asks to borrow the shares to short them. And then broker B comes along, buys the shares, and then they get re-lent back out without them knowing. So it's double lent, if that kind of makes sense. And it created this chain reaction to where there was way more lending than were shares available. So it was very over leveraged. They had way too much debt on the share, and they were trying to basically make GameStop go to zero, force them into Chapter 11 bankruptcy. And what happened was these retail investors on Reddit, the Wall Street bets, I'm sure everyone's heard that term within the past week or so, they actually found out that they were over leveraged and were short 140% shares. So the market was flooded with GameStop shares. And what happened was these retail investors got along together. Actually, it was really one main guy. His name was Kevin Gill or something out of Boston, retail trader. He's on YouTube as Roaring Kitty, and he's on Reddit as Deep Effing Value. Y'all may have heard or seen that name. It's kind of been floating around there. He started putting on YouTube that he was bullish, which means he was long and hoping the GameStop was going to go up in price. So he started pumping this information out there, getting people wild up, hyped up on Reddit, and people just started buying the shares when they were getting flooded in the market because they were getting borrowed and the brokers were selling them out to the public. And from the head side's point of view, they, for example, make numbers simple. They borrowed it at $10. They sell it back to the market, and then it's borrowed, so they have to give it back to the broker because they don't own it. They want to purchase it back at say $5, and then they make $5 a share, and they make money. That's what shorting is. So the retail investors, they wanted to stick it to the man, stick it to Wall Street. So everyone got together. They started buying all these shares in the market, which created demand for the stock. And price slowly started creeping up. I remember at one point it was about $3 a share, $3, $4, $5 a share. And within the first few weeks of of January, the stock started slowly creeping up, and it got up to about $60 or so per share. And what happened was the brokers, because the shares are borrowed, right? Let's remember that they started freaking out. They started calling the hedges, and they're saying, hey, you need to give me these shares. We need to get these shares back. So the hedge funds are like freaking out. They have to actually go out and get the shares back because it's borrowed. They have to bring it back to the broker. So they're trying to buy the shares back, because when they're shorting, it's the same thing as going long. When you're buying stock, it goes up in price, you make money. If it's going down in price, when you short, you make money. But the stock was going up. So these hedge funds were losing billions and billions of dollars a day. So they had to go out and actually get these. They had to go buy back these stocks so they can hedge their bets and recoup their losses. But what happened was Wall Street got together, and that's where hold the line. That's where diamond hands comes from. Everyone said, no, we're not doing that. We're not selling. So just like anything else in life, when there's a limited amount of things out in the public and they're hard to get, price just keeps going up, keeps going up, keeps going up, keeps going up. And that's kind of how that happened. That's how it went from in the past fall, it was about $3, $4, $5 till it got up to pushing $500 at one point last week. That's simply from the fact that people just wanted to stick it to the man, stick it to Wall Street, get back from 2008 when the market crashed. Even back last year, these hedge funds made billions of dollars shorting the market when the market collapsed. And regular people, my father even kind of got forced in early retirement last year when the COVID hit and the oil crashed. And so people like in my situation kind of wanted to stick it back to the man and make them lose money. And the hedge funds aren't going to go anywhere. They're always going to be around. They still winning. It's kind of slowed down a little bit. Even today, GameStop is back under $100. So the ride is kind of slowly dwindling down. But they lost upwards of $100 billion, and they felt the blow, and that's what the people wanted.
Exactly. I think from the whole entire GameStop situation, I think it was the workers like really sticking it to the man. Like they were like people were fighting with their dollars, and that's what we need to do. So James, I have another question. Can we see this happen again? Can this happen with another stock? Are there other stocks that are trying to be short out that people can buy into to try and, I guess, combat that?
Yes, it can happen again. As long as these hedge funds are able to short more than is available and do this double lending, double shorting in the market, flooding the market with these shares that are worth almost nothing, it could still happen again, because the day and the age of the internet, information is accessed and available now. So, for example, back in the 80s, when the internet wasn't really around, companies had to actually go and out and pay to find these reports, find this data, and the average investor, the average Joe, like me and you and my friends, they had to actually pay tons of money to find out this data. Nowadays, this data is free. You can go and find this data. Actually, every quarter, there's a list that'll show they call it the short interest, and it'll show you the most shorted stocks in the market. And if you look at the list that came out on the December 31st of 2020 at the end of the quarter, GameStop was number one. And also in that same list are, maybe you may have heard of these, and maybe the listeners have heard of these, AMC, BlackBerry. Those are other big shorted funds. So as long as these hedge funds are able to short over 100% that's available, which makes logically absolutely no sense, but they're able to do it, the people can find out this information and do exactly what they did at GameStop. But that being said, after this large blow that has been dealt with to the hedge funds, they have so much sway and pull. They're on the political contributions of both sides. They pay campaigns for all the presidents. As a matter of fact, Joe Biden, without getting into too political, Joe Biden is very on the investment, the Wall Street's payroll. No doubt they're going to try to find a way to regulate this and try to find a way to maybe limit information, or they're going to try to do what they can. They're going to pull their strings to try to make this not happen. But until that happens, it can absolutely 100% happen again.
Yeah, I heard just the other day Elizabeth Warren was talking about how like things like this shouldn't happen, and it's like, well, these hedge funds, they crush the middle class worker all the time with these same tactics, but as soon as the people use it against them, people they freak out. It's so crazy, man.
Yeah. What I see happening in the future is they may try to make this shorting over 100% illegal in some way. Because really, it makes no sense that you can short more than is available. You know,
Exactly.
you're
Yeah.
you're like you're taking a triple mortgage out on your home. You know,
Yeah.
if things go bad, you're going to be living on the street. You know, so
Exactly.
that's kind of way that I see this going, especially now that the government is getting involved. Um, Things are changing, and even after the past weekend, Friday and Thursday, when it was really hyped up to the most, after the weekend kind of cooled down, you've seen this week, if you've kind of just been looking at GameStop, for example, at the end of last week, I mean, it did peak towards 500, but it finished around 380 or so, and today it's closed under 100. So they've already kind of tried to hedge their bets, and actually what kind of happened is they've partnered with for example, Robinhood. I'm sure everyone heard that Robinhood was like freezing the stock and like delisting GameStop and AMC. So the hedge funds and Wall Street were kind of working with these brokers to halt and freeze trading so people can stop buying. As I mentioned earlier, the more you buy, the more demand goes up, the price shoots up. So people weren't able to buy. They were limited. They tried to make a purchase, and the broker would say, this share is unavailable to trade right now. So purchasing stopped, and if you held, that's why everyone was saying hold the line, because you couldn't buy anymore. So they were trying to keep the demand up, so Wall Street couldn't sell. But you start seeing those dollar signs flashing. People kind of want to take profits off the table. To tie it back, that guy I was mentioning about Kevin Gill, the deep effing value guy. I kind of been following him, and because it's kind of amazing what he was able to do. Just one individual was able to, make this whole operation go down. He was purchasing option calls on GameStop, and without getting too technical, an option gives you the right to purchase a stock at a certain price over a given time. It has an expiration date on it, and he was buying call options on, and there's calls and put on options. Put, you want the stock to go down. Call, you want the stock to go up. And he was bullish on GameStop. He was buying these option calls on GameStop a few months ago for April, expiring in April. And he paid, I think it was like $20,000, give or take, on calls. And last week he was at $30 million profit.
Wow.
Today, or not today, on Monday, he posted his update, and he lost 15 of those million. He didn't sell. So he's one of the guys pushing to hold the line. He's not really in it for the money. He's in it to stick it to the man. He could have walked away with 30 mil. He's lost 15 of that. I'm sure he's even lost more today. He's probably, maybe now he's maybe thinking about taking a little bit of profit down. He's probably down to a mil or so. I'm not really sure, but that's kind of how it's going down. Yeah.
So I have another question.
Yeah.
What do you need to become a trader? If the government does try and limit people on these apps that they can easily trade on, what are ways around it that the average common person can still be involved in stocks?
Yeah. It's very simple, very easy. Everyone and anyone can do it. I don't see the government limiting retail traders from trading. I mean, if that happened, there would be mayhem. The economy might even collapse. There would be straight uproar. I think they're going to more regulate the shorts and the 100% short selling side of the thing. But yeah, just to get started investing, I mean, my personal background, I did graduate with a finance degree from the University of Houston downtown, and my background is in kind of investing in stocks. So me personally, I may have a little bit more information than the other guy. But I started out just like everyone else. I didn't have an inheritance. I didn't have all this money to spend. I worked, and every paycheck I just put in the market. You go to a broker. I would recommend TD Ameritrade. That's what I personally use. You can use Fidelity, Charles Schwab, SoFi. These, there's quite a few of them. Me personally, I like TD Ameritrade the best. All you got to do is go to their website, open up an individual account, give them your information, your social, so you know, taxes and all that good stuff. You open an account, you link your bank account to there. TD Ameritrade, for example, starts with $0. You know, some of the other bigger brokers like the Merrill Lynch and the Charles Schwab, I know Merrill Lynch, you have to have like 25,000 or so to open an account. But TD Ameritrade, E-Trade, Fidelity, you know, it starts with a $0 balance. So you can throw $5 in there and start, you know, buying some little cheap penny stocks. So yeah, you link your bank account, and for me, for example, every time I got paid in the paycheck, I did 10% every paycheck. Just before I tell people, you know, pay yourself first. You know, Uncle Sam, they're gonna tax your paycheck. You're not even gonna get your gross. You're already gonna get hit by the time your paycheck hits, and then you got rent, bills, all this and that. It's most important that you pay yourself first before you start going and getting the cappuccinos down at the Starbucks line and going out to eat with the friends in the bar. Just throw 10%. Don't even think about it. Put it in there, and then you know, you got the rest to have fun and live on. And you know, you just kind of do that over a year. Like I said, I've been doing it for 6 years. So it was a process. I, you know, took some losses the first couple years, learned the hard way, kind of how it goes. And as long as you're determined and you know, hungry enough to get what you want, don't freak out if you make a few losses. My first 2 years, I was not profitable at all. Just straight took major losses my first 2 years. A lot of learning lessons, but you know, I just didn't give up. You know, just like anything in life. You know, I'm sure just like maybe the podcast, maybe you're learning better with every podcast, you get better and learn more. So that's what I recommend. Investing is for everybody. Buying stocks is for everybody. I know people kind of get a little put off by it with the big lingo and watching the Fox News or the CNBC and all this crazy, the charts and this and that, and they kind of get overwhelmed. But you know, just take it one day at a time, read one page at a time. You know, the definitions. Even myself going to school and, you know, being in finance, sometimes I'll come up on words I have no clue what they mean. So, you know, just pull up Google, learn what the word is, and kind of get it down like, oh, okay, so that makes sense, and just take it one day at a time.
Yeah, man, it's just a process like everything else.
Exactly.
So, oh yeah. So one last thing, James, before we end this, what is the single most important lessons you learned at the beginning? I know you say you took some losses, but other than taking losses and like piling and driving through that, what's another lesson?
So the most important thing when investing is, you know, emotions and being disciplined. You know, you need to have like a routine down, write a plan down, you know, stick to your plan. So a lot of people, when they start out, they look at the chart and, you know, they're up one day and the next day it's down and they freak out and they sell all their stock and they're like, man, that was a bad decision. And then the next week they look and it's way up and they just lost all this potential, you know, profit they could have had. So the most important thing I've learned over the years is just, you know, control your emotions. You know, having a down day is not the worst thing in the world. It doesn't go up every day, you know. Over time, you know, and I want to get this clear for the people. A lot of people get this confused, like trading and investing. They think they're synonymous, and you know, they kind of are, you know, relatively the same, but they're two different things. You know, I tell people investing is the long term. If you're going long term, it works 100% of the time. You can't fail. If you start putting in money in every check all the time, by the time you're 60, you're gonna have boatloads of money. You're gonna win. That's just what it is. It never fails. So just have that in the back of your mind. Play the long-term game. Me myself, I consider myself an investor. Even though I did jump on the GameStop craze because I just wanted to be a part of the revolution and be part of history and stick it to the man, you know. So, but I really don't like trading that much. You know, when you trade, and I know Hollywood glorifies the trading and the big stories on the news. Oh, some guy made $1 million, you know, trading this and that in a few months, and you know, that those are very few far in between. You know, trading is more short-term day traders, and you're buying low, selling high. Y'all have probably heard that before. Looking at the chart, looking for times to jump in and jump out. Some people take trades within an hour or so, and you know, that's very, very, very risky. You're going to take a lot of losses doing that. You know, when you look at the chart, When I say investing, that's more of like a fundamental thing. I consider myself a fundamental trader, and I'll get into that in a second. The day traders, the traders, they're more technicals. They're the guys always looking at the chart. Maybe you've seen them on Instagram. The so-called stock gurus who are always posting their charts and putting all these crazy drawings on the charts and all. Those all are indicators that reflect past things that happened in the past. So these traders that they're looking at the charts, they're going off of past information, and if anything comes out on the news, the market is already reflected in it. The market is very efficient. That's one of the first things we learn is if it's out in the news, the market already knows about it, and the market is already. You'll see something in the news. For example, GameStop, we'll just keep it at GameStop. Say GameStop had a good quarter and they posted a lot of revenue and a lot of profit. You'll see it on the news and you'll be like, oh, I'm going to go buy some GameStop stock. And you log into your account, you look, and it's boom, already shot up, way up. And you're already late to the party. Train's already left the building. So, trading, people do trade. And I'm not going to say I've never traded. I definitely have traded when the opportunity presents itself. And, that's more a little technical and more a little more complicated. Maybe I can come on your show another day and we could talk more about that. I'm more of an investor, and I preach investing in long-term gains for the average person. That's what I preach to everybody. That's mostly what I do, and that's looking at fundamentals. So we're looking at I don't know if you've taken any accounting classes in your college career or anything.
Yeah, I've taken a couple.
Okay, so you got the balance sheet, the income statement, the statement of cash flows, and there's really big kind of few things that I look at when I'm picking my picks. One is earnings, profit. So at the end of the day, you want to make sure the company's doing good work, they're profitable every quarter, even if it's small, steady growth. The most important thing is they're earning money. You want to be putting your money into a company that's making money, right? Because we're investors, we're thinking long term. So we're going to be looking for the future, whereas the trader is trading on past data on the chart, looking for entries to jump in, and they get burned. They just get burned. That's how I lost my first 2 years. It took me quite a while to really understand. I see, I was like, man, why am I losing all this money all the time? I see all these banks, they're always making all this money. You hear, oh, JP Morgan made $20 billion this quarter investing in so and so, and then here I am taking thousands of dollars of losses, and I'm like, what is going on? Like, I don't understand. I'm doing what the chart says. I'm looking at this indicator, the support resistance, the yada, and so I really had to learn, what investing was. And one book that I'll mention to the people so everyone can learn and read, a book that changed my entire life on investing. It's called The Intelligent Investor by Benjamin Graham. It was written in the 50s. Benjamin Graham is actually Warren Buffett's mentor, and everyone knows who Warren Buffett is, right?
Exactly.
If you read that book, it'll change your life at the way you look at investing. It's all about the long-term gain. So anyways, back to the balance sheet. You want to look at earnings. You want to make sure the company's doing profitable every quarter, every year. Put your money in there. With that comes in play is what we call the PE ratio. Now, the PE ratio is the price to earnings ratio. What that is the market price of the stock, what it's currently floating around in the market, divided by the earnings of the company. And that'll give you a PE ratio. And it differs from industry to industry. Without getting too much in there, you want a good solid PE ratio. You don't want anything that's way too high, because math formula, the market share price is going to go on top. So the bigger the top number is, the bigger the ratio comes out at the end of the calculation. The bigger the PE ratio, the more overvalued or the more hyped the stock is, which leads to potential, disappointments, which will tank the stock price. So the goal is to find a lower PE ratio, something that's nice and solid. That kind of shows that management of the company is controlling it very well. It's nice and undervalued or perfectly valued. You want to kind of jump into those. Sometimes you'll see, example, we'll bring it back to GameStop. If you go to your TD Ameritrade account, you pull up GameStop. They have all these ratios, all these numbers on the things. If you go to the PE ratio, it'll say NA, non-applicable, because they don't have any earnings. They're losing money. GameStop is they're gonna go bankrupt, and a lot of retail investors are gonna get burned.
Yeah.
It's just what it is. They're not making money. So, besides the GameStop craze and all this current history that's going on, if you see an NA PE ratio, I would just kind of stay away from that one.
Okay.
Another thing I look at is the market cap or the market capitalization. All that is the current total value of all shares outstanding. The market price of the one share of a stock times the number of shares outstanding in the public. This is going to give you the market capitalization. Now, I look for market caps that are over $1 billion. These make it more liquid. They make it easier to trade and sell, buy and sell at lower spreads. If you have market caps that are under $1 billion, they're not as liquid. There's not as much shares out there, and it's kind of harder to buy and sell. And the spread, when you go to buy a stock, you have a bid price and an ask price. And to make it easy, say the bid price is $2.05 and the ask price is $2 even. Now what the broker does, they make that 5-cent spread on every share, and that's kind of how they make their money. The more shares that are out in the public, the more liquid it is, the smaller the spread is, and the better price you and me, the retail investor, can get in. So you want to look for a big market cap. You want to look for a solid PE ratio. And every industry is different. I tell everybody, if you really want to be an investor and make money in the long term, you're going to have to read. That's just what it is. So I read 30 minutes every night before I go to sleep. You pick your industries that you like. Everyone likes different industries. Everyone likes different things. You pick your industry. You look at the top players in the industry. You kind of compare them against each other, see what the average is, see if anyone is an outlier, if anything's going bad. You kind of eliminate the weakest links, and that's kind of how I go about it.
All right, man, that is a wealth of information. So many people don't even like know where to even begin and look, and you're just here lacing them up. That
if I'm confused, you me elaborate, let me know.
Look, this is not going to be the only time I have you on, bro, because I'm pretty sure people are going to definitely love hearing about this information. People need to know about this stuff because, like we were saying earlier in the show, this is how you can bat the system with your dollars. And I mean, that's one of the things that I really preach on my show, that I try and really educate people so we can have these intelligent conversations.
Exactly. And kind of my backstory, I don't really come from a lot of money. I wasn't like the poorest guy in the earth. I don't want to throw a pity party, but I don't really come from a lot of money. Come from a single parent home. I'm not an all-star athlete. I'm not Tom Brady. I'm not in the NFL. I'm not an actor. I'm not Brad Pitt. And there's the only option for me personally was there's one way to really achieve what you want, and that's the stock market. And school doesn't teach us to this. They failed us on the system. Probably, I don't want to get into conspiracy theories, but maybe they're trying to kind of keep, the individuals away.
Exactly. That's exactly true, bro.
People have to take it upon themselves, you got to want to help yourself. And I'm glad you brought me on the show so I feel it's like my mission in life to just kind of spread information, spread the word, because it is overwhelming. It's very overwhelming. I've talked to a lot of people. They ask a lot of questions, and sometimes they don't get it, and it's kind of hard explaining things over like a direct message and text, and doesn't
exactly.
Really. So I'm very, very glad that you brought me on. I can kind of explain things. Yeah. But one more thing I want to add when I'm looking for companies. Forgot to mention this in. One thing that's very, very underrated that people kind of not look at is management. You want to see how a company's run. Just as anything else, when you go to Chili's down the road and you're eating with your family, you can tell which chilies are good, very finely run, and which ones are just poorly run. It's obvious as soon as you walk in. You want a good manager who's takes charge, has the initiative, and does good for the company, does good for his people. And the way you can find that is, employee satisfaction, customer satisfaction, earning profits, eliminating debt. Speaking of debt, one more thing I want to add. This is very important. We're going to bring it back to the balance sheet. Balance sheet is one of the reports that every company that's listed on the stock exchange has to release. The balance sheet, take it back to accounting 101, is assets equals liabilities plus equity. So all that means is anything that GameStop owns, everything that it owns equals liabilities, borrowed money that they got from the bank, plus everything they own. Everything they own individually or stockholders own, plus the borrowed money from the bank equals everything GameStop owns. So you want to look at a debt to equity ratio. The debt to equity ratio is going to show you how leveraged the company is, how much debt they have. Debt is good. You don't want to have anything that's all equity, because debt gives opportunities to companies where they can get extra funding to create, better opportunities and better infrastructure and things like that. But over leveraging is a big no-no, and you will get burned. A good percentage for me, kind of just throw it out there, is like a 40 to 60%, 40% debt to 60% equity, or 30% debt. So if you have anything over that's pledged in debt, they're going to be having problems later down the line, especially if something in the market happens like Corona and they're not able to sell, the restaurant shuts down, and they have all this debt and all these payments due. They're going to be in big trouble. You don't want to have your money tied up with them. Yeah. So hopefully, I hope the listeners are paying it. I know I'm throwing a lot of words out, a lot of definitions, some math and stuff, but this is kind of what I do. This is what people do, and it's nothing hard. It's simple calculations, dividing, multiplying, plus and minus. There's no calculus. There's no trigonometry. There's no quantum physics. It's very simple. Just on yourself.
Yeah, it's not as scary as like people have this notion of, oh my God, the stocks, I gotta read, like you were talking about, you gotta read all these balance sheets, and like you said, there is some reading, but it's not so overwhelming and so scary.
Yeah, and actually I got the book with me right here. It's one of my favorite books. This is what it is, The Intelligent Investor, Benjamin Graham. If you read this book, it is a little thick. It's very simple though, and it explains a lot of ratios, a lot of balance sheets, a lot of numbers. If you can read this book, if you can get it, you can find it for $15 on Amazon. This will change your life. It'll tell you everything you need to know, how to be the intelligent investor and not the panic seller, the day trader. I know the Hollywood movies are cool to watch and they're fun to watch with your friends at the movie theaters, but that's not the way you want to go. You're going to lose a lot. You're going to get burned.
So James, thank you so much for being on the show, man. Thank you for educating us, on teaching us what we need to know about the stocks, some very important lessons. I wanna thank you for coming on the show. I want to tell all my listeners to hit that like button and hit that notification bell so you don't miss out on any uploads. Thank y'all very much for watching.
One quick thing, Gion. We're still rolling.
We're still rolling.
Listen to the listeners. If you guys want to follow me and learn more about investing, I do have an Instagram, JamesD_investor, and I send a lot of info out, further elaborating on some of the things we talked about today. I even kind of send a few of my stock picks out on my Instagram stories. So if anyone wants to follow me and kind of get some more information on the market and learn some more, follow me on Instagram, and you can get some more information that way. And I'm also going to be starting a small financial investing equity fund here in Houston. We're kind of getting the groundwork going down. We just filed paperwork with two of my friends. It's going to be Galactic Capital Family, LLC. And once we get licensed, we're going to be helping the people in Houston and Texas and anyone else, retail investors, helping them get in the market. We're not your grandfather's hedge fund. We're not Wall Street. We're going to be investing in things for the future, clean energy, waste to energy, electric vehicles, marijuana, psychedelics, AI
Yes.
technology. So be on the lookout for Galactic Capital and follow me on Instagram, JamesD_investor. And I just want to thank you again, Gion, for letting me on. You got a great show going here. I love RawTake, and I'm just excited to be a part of it, man.
Thank you so much, man. We're gonna drop all of his info in the description. So y'all best hit him up, man. All right, y'all. Y'all have a blessed day.